Ladies and gentlemen, good day and welcome to the Q2 and H1 FY2024 earnings conference call of Piramal Enterprises Limited, hosted by JM Financial Institutional Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Desai from JM Financial Institutional Securities. Thank you, and over to you, Mr. Desai.
Thank you, Michelle. Good evening, everyone, and welcome to the second FY2024 earnings conference call of Piramal Enterprises. Firstly, I would like to take this opportunity to thank Piramal team and the management for giving us this opportunity to host the call. From the management team today, we have Mr. Ajay Piramal, Chairman, Piramal Group, Mr. Anand Piramal, Executive Director, Piramal Group, Mr. Jairam Sridharan, Managing Director, Piramal Capital and Housing Finance, Mr. Yesh Nadkarni, CEO of Wholesale Lending, Mr. Rupen Jhaveri, Group President, Ms. Upma Goyal, Chief Financial Officer, and Mr. Ravi Singh, Head of Investor Relations at Piramal Enterprises. As always, we will have opening remarks from the management team, post which we will open the floor for Q&A. Over to you, sir. I would like to transfer the call to Mr. Ajay Piramal for his opening comments, post which we will take the questions. Thank you.
Thank you and welcome to our earnings call. Let me begin by wishing all of you a very happy Diwali and best wishes for the festive season. Before diving into our results for the quarter, a few comments on the macro backdrop in which our company operates. The global macroeconomy is clouded with uncertainties arising from record high inflation, geopolitical conflicts, tight financial conditions, and Chinese economic slowdown. Amidst this, India has demonstrated exceptional resilience fueled by strong domestic economic fundamentals. India's financial sector is playing an important role in ensuring sustained growth across vital sectors like infrastructure, real estate, and retail. As capacity utilization increases, demand for credit to invest in private capex will rise further. Indian banks and NBFCs have strengthened significantly in recent times, backed by several regulatory and supervisory initiatives of both banks and NBFCs, making them ready to meet this growth in credit. Large NBFCs have witnessed improved asset quality, higher capital buffers, and improved profitability over the last few quarters. Indian NBFCs have undergone a strong recovery despite a difficult operating environment characterized by COVID, high interest rates, and global economic and financial uncertainties. Retail credit demand has been strong. The current festive season has taken off well, and we expect the momentum to continue with improving economic conditions. However, El Nino can pose a risk with lower acreage of the winter crop affecting rural consumer demand. We need to be cognizant about slippages that may emanate from these markets. We are optimistic about our loan book's growth going forward and at the same time vigilant on prevailing risks, including unsecured lending and the rural slowdown. Real estate demand continues to remain buoyant. While annual growth rates may come off the post-COVID peak at a pan-India level, there are markets where demand will continue to remain high, buoyed by India's rising economic activity and growing middle class. Moving to our company's performance and how we have delivered during the quarter, our Q2 performance was in line with our strategic focus of building a diversified retail business, an accelerated rundown of Wholesale 1.0, and building a granular Wholesale 2.0 book. Firstly, it was encouraging to witness the AUM getting in a growth mode. Our total assets under management grew by 4% Q-on-Q to 66,933 crores after 7 quarters of broadly unchanged overall AUM. Retail segment led this growth with the AUM growth of 55% year-on-year to 38,604 crores. Retail now comprises 58% of our total AUM versus 33% at end of March 2022. Within wholesale, the wholesale 2.0 AUM is up 48% quarter-on-quarter and now stands at 4,500 crores across real estate and the corporate mid-market lending. Wholesale 1.0 AUM is down 8% quarter-on-quarter to 23,827 crores. This is a 45% rundown since March 2022. Secondly, another key highlight for the second quarter of FY24 is the reduction of 13% quarter-on-quarter in the wholesale SR book to 3,259 crores. Thirdly, on retail asset quality, the TPD trends were either stable or down across all our retail products. Thus, consolidated GNPA ratio was down 10 basis points quarter-on-quarter to 2.7%, while the NNPA ratio was flat at 1.5%. Lastly, on operational performance, during the second quarter of this year, the improvement in yields drove the NIM expansion of 38 basis points quarter-on-quarter and NIL growth of 10% and net interest income growth of 10% quarter-on-quarter. Fee income growth at 39% quarter-on-quarter and 159% year-on-year was also strong. Thus, our PPOP, excluding dividend income, grew by 27% from the last quarter to 237 crores. This, along with broadly stable credit costs, meant that our PAT, excluding exceptional items and one-offs, stood at 113 crores versus 30 crores in the first quarter. In the second quarter, we also successfully completed our share buyback of 1,750 crores as announced by the board last quarter. We remain strongly capitalized with a net worth of 28,710 crores and capital adequacy ratio of 31% on a consolidated basis. With these highlights, I will now hand over to Jairam, Yash, and Upma to discuss segments with specific highlights.
Thank you, Chairman sir. I will walk you through the details of the retail lending segment and then hand over to Yash for the wholesale side of the business. Our retail AUM scaled 55% year-on-year, coupled with growth in quarterly disbursements as well, of 57% year-on-year. So for the second quarter, our disbursement yield stood at 14.3%, while the overall yield stood at 13.2%, excluding the POSI book. Our housing loan disbursements grew 55% year-on-year, with an average ticket size of 18.1 lakhs for the second quarter. 77% of our retail AUM is made up of secured loans, an average CIBIL score greater than 750. 90-plus delinquency in all our retail products are stable to down and are currently well under control. Our unsecured retail across 4 different product lines stands at rupees 8,512 crores. In recent months, there has been a lot of conversation on risk in unsecured lending. We believe this is a healthy conversation to have, and we have flagged it multiple times over the course of the last year. Over the last 2 quarters, through various measures to tighten credit lending, our disbursement volumes in unsecured have declined. Simultaneously, the risk metrics have remained benign with a slightly improving bias. 90-plus delinquency ratio has decreased from 1.6% at the end of last quarter to 1.4% as of September end. In this unsecured segment, we serve over 13.4 lakh customers with an average CIBIL score of 760. We continue to make steady progress towards the long-term operating profitability metrics, which we have shared with you in the past. Our yields in the retail business are steadily increasing on a book basis. Fee income is improving. OPEX ratio is lower than at the end of last year and flat QOQ, and asset quality continues to be benign. As we continue to expand our retail lending business, we also continue to invest in manpower, branch infrastructure, technology, and analytics for future growth. During the quarter, we added 19 new branches, aggregating now to 99 branches over the last 12 months. With this, today we have a network of 442 full-service branches and 142 microfinance branches across our network. We serve across 596 districts in India across 25 states. Our customer franchise now stands at 3.6 million, thus acquiring 2.5 lakh new customers during the quarter. Our active customers out of this 3.6 million is at 1.1 million. With that, I'll hand over to Yash to walk us through what happened in wholesale lending during the course of the quarter.
Thanks, Jairam, and good afternoon, everyone. In wholesale lending, we have achieved an accelerated rundown of 45% since March 2022 in our 1.0 AUM, in line with our strategic focus. Wholesale stage 1 AUM, excluding non-yielding assets in the nature of land assets, receivables, security receipts, and DHFL, on which we don't record yield. On that book, it stood at about 17,381 crore. We had an average yield of 12%. Our stage 2 plus 3 AM combined reduced 63% year-on-year to rupees 4,126 crore, with a provision coverage ratio of 32%. We continue to focus on resolution of stressed assets, which will shrink the wholesale portfolio in the short term, as we have communicated earlier as well. A dedicated team is involved in monitoring and executing the resolution strategy for some of the complex recoveries and enforcements aimed to improve recoveries and monetization of assets on an accelerated basis. Security receipts reduced by 9% QOQ, and is the first quarter during which we actually saw a decline in security receipts to a number of 4,862 crore, of which 67% have been relating to wholesale loans on the underlying assets. With this, our wholesale SRs reduced by 13% QOQ to a number of 3,259 crore as of Q2 FY24. As the resolution process continues, we expect our SR portfolio to reduce in the near term via a combination of sales, enforcement, and collections at their carrying value, while few more ARC sales are expected over the next two quarters. In wholesale 2.0 AUM, we are focusing on building a granular and high-quality portfolio, wherein our 2.0 AUM grew at 48% QOQ to 4,501 crore across real estate and corporate mid-market loan strategies. Our 2.0 loans are performing well and are in line with or ahead of underwriting, as reflected in significant prepayments that we have received today. We received about 966 crore from wholesale 2.0 over the last 6 quarters, which illustrates the credit quality of the underlying portfolio. We disbursed 1,819 crore in the second quarter of FY24, of which 1,115 crore was disbursed in the month of September 23. The average ticket size is around 172 crore for real estate loans and 64 crore for corporate mid-market lending in this version of our AUM. We will further build this book in a calibrated manner while capitalizing on the market opportunity. With this, I'll hand over to my colleague Upma to cover financial performance and liabilities.
Thank you, Yash. Covering our financial performance, in Q2 FY24, our net interest margin expanded by 38 basis points Q on Q, supporting the net interest income growth of 10% quarter on quarter. Fee income continues to scale up well and was up 39% QOQ. Our OPEX was up 6% QOQ to 664 crores, led by growing retail business and our investment in tech platforms and distribution. Thus, our pre-provisioning operating profit, excluding dividend income, went up 27% quarter on quarter to 237 crores. Credit cost was at 1.2% versus 1.1% in quarter 1 FY24, which is in line with our expected range for credit cost. During Q2, in furtherance to the order dated 5th September and 20th September 23 of the Honorable Delhi High Court, Piramal Fund Management Private Limited, 100% subsidiary of Piramal Enterprises Limited, has agreed to refund or return the principal amount to all investors of Indirect PMS as a one-time payment without admission of any liability and without prejudice cases. This led to recording of exceptional loss of 64 crores during the quarter. Our reported profit after tax for Q2 FY24 stood at 48 crores versus 509 crores in Q1 FY24. Profit after tax, excluding exceptions and one-offs, stood at 113 crores versus 30 crores in Q1 FY24. On liability management side, we continue to focus on diversifying our borrowing mix, including securitization. Our fixed to floating rate debt mix improved to 54 to 46, and we continue to see further improvements over coming quarters. Our cost of borrowings remains stable at 8.6%. Our ALM is well matched with positive gaps across all the buckets. With this, I'll hand it over to Chairman Sir for concluding remarks.
We have given you a brief update of the first this quarter and of the first 6 months. The documents have been, the investor presentation has also been uploaded on the site. And now I will ask you to open the floor for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and one on the touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to only use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avinash Singh from NT Global. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. So, 2 questions. The first one would be around your credit cost, that is close to 2 billion. It has so many moving parts. If you can just help me understand that, that 83 crore that you have taken a hit on the loan you have de-recognized, what was the provision already there? Because it's the net negative 244 crore I see. That will be a kind of sum of parts that you would have reversed whatever you were provided on this part of the loan being de-recognized, and you would have incrementally provided something there. Also, to help us understand what part of your other income that you have given in note that majorly is the recovery from write-off. Is there some related income also in there? And if I were to look at the fair value gains line item 78 or so, is it majorly now from the revaluation of SRs? So this is question one. The second is that, okay, in terms of your QOQ reduction in wholesale 1.0, if you can just provide the sort of a breakup, how much of it is kind of the regular prepayments, or how much of that is coming from the sell down of either the stress loans or standard loans? Thank you. These are the questions.
So that's a lot of questions. Okay, we'll try and take it in. So we will do the credit cost question. So there are three parts to your credit cost question. I'll try and take it. Upma will add whatever I might miss, and then Yash will talk you through the wholesale 1.0 side of the story. See, your first point of how much exactly kind of the gross to gross comparison to essentially say, hey, kind of did new stage 3 get formed? Did stock get derecognized and kind of written off and go off the books, and how much was it? Like I think the best way to kind of look at this is on a net basis. So 1.2% credit cost is probably the simplest way to look at this. That's what we have guided as well, that on a net basis, we expect our business in the long run to be about 1.5% credit cost business. We are at 120 basis points. Every time we derecognize something or we write off something, obviously we will make incremental provisions and bring it up to 100% and then derecognize it, right? Obviously we can derecognize only assets that are 100% provided. So yes, part of this has gone towards that derecognition. The stage 2 and stage 3, whatever is left on the books right now, you will see in our investment presentation on page 37 that 37, no? Total. That stage 2 plus stage 3, the provisions are broadly the same. There may be a little bit less in compared to last quarter. So they're a tiny bit less than last quarter. 200 is the net credit cost that we have had. You can do the math and figure out what is the gross level incremental provisions that we've had to make to write off the cases. So that's a couple of 100 crores that you will see there. As far as recoveries are concerned, you had a side question there about are part of the recoveries coming from FLDG? The answer is yes. We had a 2-digit number. We're not disclosing the specific number, but I'll just say that it's 2-digit number, which is sort of, which is coming from FLDG. Yes, we do have FLDG recoveries as, showing up as part of that as well. There was a third part to this question, which was, did you have SR? You asked whether the revaluation was about revaluation of SR. Not really, no. The revaluation of SR just got created, so it would be premature for us to start revaluing them upwards. A lot of the revaluation ends up happening actually on our old POCI book, where cash flows come in, and so that we end up doing some revaluations. So that's what you're seeing, that it's not nothing to do with SRs right now at least. A year from now, if SRs are behaving really well, we might consider some revaluation, but it's too early at this point of time. Yash, you want to take a question on wholesale 1.0?
Yeah, I think your question, if I got that right, was the reduction in stage 2 and stage 3 book, right? What was the source of it?
I mean, overall, your QOQ reduction in wholesale 1.0, how much of this wholesale 1.0 reduction is like from 8% QOQ, how much of that in absolute amount is coming because of the for your regular payments, and how much of it is like asset sell down, whether it's stress or standard?
Yeah. So I think predominantly it has been organic recoveries where the underlying assets or a pool of other capital has taken out from the underlying position. I don't have the exact number, QOQ handy to answer your question, but it has been a mixture of the two. If I were to take a step back and tell you the composition of the repayments over a longer period of time, which is really the trend you should focus on, about 75% plus have been sourced through the asset cash flow themselves, right? The material part of the reduction that we have seen has come through the performance of the underlying assets and the partners who we work with to be able to achieve that performance.
Okay, and if I can just follow up, let's look at the 6% net basis, 200 crores odd number for the quarter. If you can provide out again, how much of it is wholesale 1.0, wholesale 2.0, and retail?
See, the numbers are there. No, if you look at our page 37, and you can see the stock that is there, and if you see our SEBI disclosures, you will get to see kind of the recoveries that we have got. The best way to think of this is, of say about 200 crores. Right now, retail credit costs are going to be very small because retail is still a young book. Much of the credit costs, both the credit costs getting formed as well as the recoveries coming in, are all going to be kind of related to the wholesale part of the book. The retail part of the book will slowly come. So I think that it's good enough right now. We're not making segment-specific credit cost disclosure, so I'll just leave it at that at this point.
Okay, thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, we request you to limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Sir, I think coming back to SRs.
Excuse me, sir. I'm sorry to interrupt, sir. Your voice is muffled. If you request you to use your handset, please.
Is it better now?
Sir, please proceed. We'll let you know.
Yeah, is it better now?
Yeah.
Yes, this is
I just wanted to understand the SR time that has happened. So whenever the SRs run down, what impact will it have on the P&L, or to which item will it get counted? Essentially trying to understand, there would be a certain fair value at which you would be carrying SRs on your balance sheet. So once SR is also this quarter as well, you sold down SRs, I think it has SRs to ARCs, which has led to the decline. So when we sell down SRs, is there any component that comes and in the P&L, any line item which gets impacted when you sell down SRs to ARCs?
So Abhijit, when we sell down the SRs, if we are realizing the full SR value, there will not be any impact on the P&L. Any amount more than the SR value will go in the credit line item in the P&L. And if we are reducing by way of NAV, the impact comes into the loss as a loss and gain onto the valuation. So the reduction, what you are seeing it in our quarter, is a recovery without having any significant impact on the P&L.
We haven't added SRs in this quarter. In fact, the SRs have got redeemed. That's the point I was having.
No sell down to ARC.
Yeah. There is no sell down.
There's no new sell down to the ARC.
We have recovered.
The SRs, we have been able to sell, and we have been able to recover, equivalent value. So there's no meaningful P&L impact one way or the other during the course of the quarter.
Got it. Then, the second question that I had was on this retail yield. So, I mean, obviously you've given out in your presentation why QOQ there has been moderation in the retail yields, because you've kind of cut down your unsecured disbursements. I just wanted to understand at the overall company level, your yields have actually improved sequentially. So what has led to that? I mean, is there some other component in interest income?
Sure, ma'am. Sure. So more of the mix that keeps moving towards retail, you will keep seeing this. It's we are even after the moderation in yield in retail, we are still at 15.25 incremental for the quarter. So that's what you're seeing. By the way, let me make one other point on that moderation clear. We were at 14.7 at the end of during last quarter in terms of disbursement yield in retail. That 14.7 went to 14.2. Some part of it is mix shift, as you rightly mentioned, less unsecured. But the other part, which is also equally important, is that within unsecured, particularly in the partnerships business, the new RBI guidelines on partnerships and FLDG, etc., and digital lending have come during the course of the quarter. That led to some realignment in commercial. where earlier I might have charged a higher part of the interest to my P&L because I was not able to get the clawback from an FLDG format. Now in an FLDG format, I will actually charge less from an interest perspective, but I have that FLDG cover at the back end, so it will not show up in my credit card. So that commercial rearrangement has also happened, which is what has actually shown up in the yield number.
Got it. Okay. And then maybe one last question that I have is, I mean, in one of the notes that you've given out in this financial statement, you talk about this principal business criteria for our HFG subsidiary. So wanted to understand, as on September, where are we? And going forward, is it fair to expect that maybe because we are required to meet this principal business criteria by March 24, which I believe is 50% at the overall level and 50% in individual home loans, will be kind of accelerating the growth in mortgages?
See, I think the current position is that we are well short of where we need to be. Having said that, we have known this for a while, so we have been in conversation with both NHB and RBI, and while I cannot tell you specific details of that because that's privileged communication with the regulator, but suffice to say that we are in conversations with the regulator and they are well aware of what our realistic goals are. One of the things that you've got to be careful about in the lending business is trying to achieve extraordinary growth numbers just to achieve some of these portfolio mixes can have debilitating long-term effects. So we have to be careful about what we can do. In that, there are some things which are realistically doable and some things which are not that realistic. And we have been very upfront and open with the regulators on this matter and are in active conversation.
So then is it a case that in case you don't meet that criteria by March 24, you might have to go back to the regulator for an extension?
As I said, we are already in conversations. We are not going to wait for March 24. We are already in conversations with them.
And so just one last question, sorry. So you've been last quarter cleaning up your balance sheet. I mean, last quarter we had taken goodwill write-offs. This time you've done some cleaning up on the India side. I mean, are there, more cleanup of the balance sheet that's envisaged in the next few quarters, or do you think we are largely done with regards to just cleaning up of the balance sheet?
We think we are largely there. There might be one, as you can see, the size of some of these cleanups is getting smaller and smaller every quarter. We don't think there is anything kind of major that that's out there. Minor things might come up every now and then, like in all spring cleaning, Vijay, like you might realize some other little thing in some corner, but nothing material.
Okay. This is very useful. Thank you so much. Wish you and your team the very best.
Thank you. A reminder to all the participants to limit their questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, hi. So again on this question at the company level, so once again to clarify, it is when we are running down the wholesale book, there is no component of any maybe one of interest income which is got booked into it, and it is purely the mix shift which has led to get this overall yield increase despite the decline in the retail yields. Yeah.
Correct. There is no one-off here. I will point out, however, that in the past, in quarters when you have significant NPA formation, you might see reversal of interest. This quarter, we have had neither reversals nor any one-off gains in the.
Yeah. There's no recovery income which is there. Okay, which is in the yield. Okay. Yeah. And any particular reason in terms of maybe the overall stage 2 and stage 3 provision coverage being low? I think you highlighted some points with respect to write-off. So is that the only component, or there are change in any of the assumptions, or both stage 2 level or full we are a bit lower? Otherwise, there is not much change. In fact, at the number, but still provisioning the number is down. Yeah.
Yeah. You're talking within wholesale or at the full company level?
Whole company level and primarily it's coming in from wholesale only largely. Yeah.
There is policy changes we don't do in the middle of the year, so there's nothing that has changed between last quarter and this quarter. It's exactly the same provisioning and ECL policy. In the wholesale side of the business, so there are two factors here that you should keep in mind. Firstly, that the wholesale and retail mix will keep changing in stage 2 and stage 3, and wholesale and retail, and even within retail, which product it is, will actually change the percentage provisioning that you will see in stage 2 and in stage 3. So if it's an HL, it might be 2% or 3% in stage 2 and 22%, 23% in stage 3. But if it's a PL, it might be 30% in stage 2 and like 70% in stage 3. It could be very different depending on the product mix that's in stage 2 and 3. So product mix matters in this, even if the absolute headline number is the same. The second point that I would make is that in wholesale, because assets are lumpy, stage 2 conversations happen on an asset-to-asset basis. So LGD assessment you need to do on an asset-to-asset basis, and that might sometimes, depending on which asset is in stage 2 this time versus last time, it might create small deltas in terms of provisioning. But policy-wise, nothing has really changed. Yash, anything you would add?
No, absolutely. No,
cool.
The only thing I'll add is change is very marginal, right? As you can see on the numbers. Page 38.
Okay. Yeah. Thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Hey, hi, Jairam. Just getting back, follow-up questions on some that were asked earlier. These are more accounting related. Now, how do I reconcile your credit costs of 198 crores from the consolidated P&L, the BSC release? Because from there, it's like, shouldn't just be deducting 244 crores from the 60 crores, and therefore that 440 odd crores should be of credit cost?
Can I just answer this part? You also have to add the other operating income, which is 184. That's the recovery we got it from the rate of recovery from the prudentially written off account.
Okay, so this is a net credit cost, net of bad debt recoveries.
Absolutely. Correct. Now we are showing it in our higher debt.
Okay. And so just to be clear, the write-offs this quarter is in 63 crores.
184 crores.
No.
Write-off, not recovery, write-off.
New write-off is? No, the number is a little bit too big. I think it's more like in the 400 crore range. We will take this up offline and we'll show the exact numbers. Mota moti 400 crore कुछ का write-off है यार, और 200 crore का write-off recovery है. और net अपना credit cost जो है 200 का है. मोटा मोटी ये math है.
Okay, fair enough. Second thing, just again on accounting, the SR book of almost 5,000 crores, that's in your investment book 8,000 crores. Is that right?
It's in the investment book, yes. But it also shows up in our AUM. When we show AUM, we add both loan book and this SR book in it.
Fair enough. And so when you recover money from the SR, basically the something that goes to the P&L and this investment is converted into cash on the balance sheet, and that's how the balance sheet balances.
Correct. That's the delta between the consideration that you get versus the book value will flow through P&L.
Fair enough. Okay. That answers my question. Thank you.
Thank you. We'll take the next question from the line of Viral Shah from IIFL Securities. Please go ahead.
Hi, Viral.
Hi, Jairam. Actually, I have maybe two questions for you. So, one, can you give me the number in terms of 30 plus CPD for each one of your core retail loan segments, including the unsecured?
छोड़ना यार, जान मत ले. 90 plus दिखा रहे हैं हम, मतलब देखते हैं. We'll see whether we want to show. I've not started 30 plus का disclosures. We'll see whether it is useful. Right now, 90 plus trends we have started showing as a new disclosure this time. 90 plus trends for the last 5 quarters. See whether this is useful. I will just tell you that the storyline in 30 plus, while the levels are different, the storyline is absolutely no different. It shows exactly the same pattern. There is no accumulation that's happening in 30-day and 60-day buckets. If that's what you're looking for, there is no accumulation there. So the trend lines are very, very similar. The absolute values, we'll see whether we want to start doing disclosures in the future.
Because last quarter, in the investment, you had given out 30 plus DPD, so that's why I am asking.
But we don't want to do it every quarter, yeah. That metric is a little bit more volatile. There's no point actually just confusing it. I think 90 plus is a good metric for us to, for us to continue to share. We'll see whether we find it useful or maybe annually start showing it or something like that. We'll see. But as I said, please take a look at a 90 plus and just the deltas. 90 to 30 ka delta, what you saw in the analyst day, nothing has changed. So trend lines are exactly the same.
So, okay, just building over there, you mentioned the trend line is similar. So, versus the last quarter where your unsecured loans had higher delinquencies quarter on quarter, that trend continues for unsecured directionally, or has it come down?
It has come down. No, like I think this quarter it has come down. Same thing has happened in 30 plus also.
Okay. Fair enough. And the second question I had was on the comment that you made with regards to FLDG and earlier FLDG being there. So just to understand this right, so now you have the FLDG cover. That's why the yields that you get would be relatively lower. Earlier there was no FLDG or even quasi-FLDG.
There was a quasi FLDG, that's why we had a higher part of the yield accruing to us, and that we would keep aside. And if credit event happened, we would not, pass on that higher yield to the originator, because that's the service deficiency. But if the service was full, in the sense that we did not see a higher level of risk, then that higher yield would eventually get passed on back to them.
And can you give a sense of what's the, of course we know the cap on the FLDG. Is the quasi FLDG now down to zero, or is it still there?
It's still there. It's still there. It's not as large as the FLDG is, but it's still there.
Thank you so much. That's it from me.
Thank you. We'll take the next question from the line of Adarsh from Enam Holdings. Please go ahead.
Hi, Jairam and team. Question to kind of realign your interest income. Just wanted to understand on the stock basis your yields would be north of 13 at least.
On a stock basis, 13.2 excluding POCI and 13.8 including POCI.
Got it, Jairam. So because then would it be possible to give out, you have a wholesale AUM. What part of that is interest earning, like your stage 1 and stage 2 is about 28,000 crore. Does all of it accrue interest? Because, the implied yields on that seems to be low if I take retail yields of 15%. Then you have an investment book. If you do all of that, there is very little interest income left out of the wholesale book.
Let's look at page 26 now. Page 26 में header जो है, it shows stage 1 AUM, ये wholesale का AUM is 17,381 crores, average yield is 12%. This is the yielding book.
So this is the yielding book, is it? Out of 28,000 crores. Okay, got it. This kind of adds up. This is helpful, thanks.
So just to remind everybody, the non-yielding part of the book is SR, land and receivables, and then some DHL book, which is non-yielding. So apart from delta is, both of आने के बाद 17,381 is the yielding book in wholesale.
This is helpful, Jairam. Thanks.
Thank you.
Thank you. The next question is from the line of Arvind Chetty from Diamond Asia Capital. Please go ahead.
Hi, sir. Thanks for taking this question. Just one question on the new customer acquisition, the retail part. So that's slowing down significantly on YOY and QOQ basis as well. You explain the reasons, because I understand on the digital part we are slowing down a bit.
It's a good observation. It's all driven by the slowdown in unsecured. In terms of sheer number of customers, unsecured always gets you lot more customers, order of magnitude more customers than secured. So while our secured business has been growing really strong, as you've seen in our numbers over the last 6 months, our unsecured business has slowed a bit, and that is what's resulting in a in a smaller customer acquisition, it will come back up. As and when we get more comfortable, we've made a lot of credit policy changes over the last 6 months in this business. So as we get more comfortable with the credit quality of the new book that is actually getting booked, you might see us step on the accelerator a little bit more in the future, and you will see that come up. Your observation is right, but it's all got to do with reduction in unsecured.
Understood. And my second question is on the fintech partners that we have. So would we go ahead and sign FLG with all the partners and the 5% or
as I said, about 70% of our business is done with partners on the FLDG format, and the rest are not. The rest we have, let me put it, 50% is the FLDG format, 20% is non-FLDG, but some other form of credit enhancement by the partner, and the rest 30% is risk on our own.
Got it, yeah.
Thank you.
Thank you. The next question is from the line of Vinod Jain from WF Advisors. Please go ahead.
Good evening. I seek a better understanding of two items of P&L. One is the net loss on derecognition of financial instruments under amortized cost of 63 crores. And the second is the impairment allowance reversals of financial instruments of 2.9 crores. My question is only twofold. One is, are these interrelated? And two, what is the view on these items?
Loss on derecognition of financial instruments.
I'm sorry to interrupt. Ma'am, your audio is too low, ma'am.
This net loss on derecognition of financial instruments is primarily on account of assets which has been actually moved out of the balance sheet.
Right.
Right. Now, impairment is the actual impairment of that instrument. It is nothing but in the form of ECL, expected credit loss. So when we look into the overall credit cost, we have to add up these two lines because there is a process. When we actually sell down the book, it moves from the ECL to the net loss on derecognition of financial instruments.
Okay. Then what is the view on these going forward, madam? Can you give us some understanding of the view on these?
See, we're talking about the credit cost. So when you have to look into the credit cost, that is the range you have to look into it. So that's roughly 1.2 sort of a number what we are being expected.
1.2, madam?
Yes.
All right. Thank you.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Thanks for the follow-up. So, on the unsecured part of it, if I look at the details in the presentation, is that disbursement particularly lower on account of maybe if we have to break it into the various segments, then what would have led to this decrease in the disbursement? Is it more of a digital, personal, unsecured SME, and what on account of tightening on the norms and what we would have done? Or maybe any of the particular partnerships we are evaluating what is happening out there, and where should this stabilize? Is it like this downtrend get to continue in this kind of an environment here?
Yeah, no, good question. So, of the 4 products that we speak about in digital unsecured, microfinance is roughly the same as what it was in Q4. Nothing much has changed there. It has neither gone up nor down. Unsecured MSME is, it was low in Q1, but it's come back to Q4 levels now. Personal loans is higher than where we were in Q4. All the reduction has actually happened in digital loans, the partnership-driven business. That's where all the reduction has come. The business is now roughly 1/2 the size that it was in Q4, and all of it is through tightening of credit criteria, not by selection of partners. Across every partner, our business volume is down because we have just tightened credit criteria. As I've mentioned in the past, we had a first round of credit tightening in November and another significant round of tightening in April this year. That's what has actually started to show now in terms of the numbers. In terms of outlook, I think this downward reduction is kind of done. I feel comfortable now. Looking at the last 6 months of originations, Kunal, we are feeling pretty okay with the credit quality, the new business credit quality in terms of early risk, etc. It's looking good. You might see us actually bend this curve and start going in the other direction, soon enough.
Okay. So if you could explain in terms of the proportion, maybe when we look at it in terms of the partnership, it is also down from, so it is down from 44 to 41 odd percent. And incrementally we are doing more of the business in the countries wherein the proportion has now gone up to almost like 51 odd percent also.
So just to put a rupee crore number on it, in the month of March, we did 750 crores of business through partnerships, digital loans through partnerships. In the month of September, we did 350 crores.
Okay. And nothing much to read into the increase in the ticket size, which is in their digital loans. 40 to 50.
So partnerships make the ticket size is smaller. So if that proportion comes down, the average ticket size will go up.
Okay. Got it. Thank you.
Yeah, bye.
The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi. To understand the FLDG with the partnerships, are we at 5% or is there something more than 5% with certain partners? This first. Second is, what kind of ticket sizes minimum are we doing and maximum are we doing in terms of personal loans? And the minimum and maximum IRRs we are doing in personal loans.
Okay. See, on FLDG, regulatorily, FLDG is capped at 5%. So practically in all cases that we do FLDG, we will be at 5%. There might be some other commercial arrangements that we might have with the originator, but within the FLDG format, you can only do 5%, and that's kind of where we are. Your question on ticket sizes, I think, and your ticket sizes and yield, I think. On ticket size, see, we do all ticket sizes, but I guess you're trying to figure out what is the small ticket exposure that we have is within the unsecured population. So within that 8,500 odd, which is there in unsecured, this small ticket unsecured, which is kind of been the subject of a lot of conversation, less than 50,000, we have about 480 crores. So it's a very small percentage of our overall exposure in unsecured is less than 50,000. Less than 25,000 is about 175 crores. So our ratios are very small. I think a lot of you have heard this in other calls as well, but so let me also add some information to the same conversation. We do also see on our portfolio the same dynamic, which is that the smaller the ticket size, higher the risk. While we talked about 1.4% as the overall 90+ delinquency of unsecured, when you look at the less than 50,000 category, that 1.4% basically doubles. And actually a little bit more than doubles. It's something like 3.5%. And if you go even smaller, if you just look at the less than 25,000 rupee category, that population is something like 6%. So it doubles again. So there is almost 4x differential between the regular PL and the really small ticket PL right now in terms of risk that we are seeing on our portfolio. But the less than 25K portfolio is very small for us, 125 crores, and less than 50K is about 480 crores.
Right, just to come back to FLDG, my fair understanding of FLDG is that it's an over-the-counter contract between the lender and the originator, so it can be plus or minus of 5%. But then when the regulator says that it is going to be capped at 5%, it means that it's going to be 5%, right? How can we have another commercial arrangement with the originator?
I will not be able to talk about that on this call, man. Let me just reiterate that our FLDG is capped at 5%.
All originators?
Yes.
Mr. Mishra, do you have any further questions?
No, thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Jairam Sridharan for his closing comments. Over to you, sir.
Thank you, friends. To conclude, the performance of the company in the second quarter and the first half FY24 strengthens our confidence on the company continuing in growth mode and improving profitability to our stated goals. To achieve this, we remain focused on our core strategic priorities. Number one, building a leading housing-focused diversified retail business with our high-tech plus high-touch strategy. Number two, effectively running down our wholesale 1.0 AUM while building a profitable and robust wholesale 2.0 AUM. And number three, optimizing our capital allocation and achieving steady-state ROA for our shareholders. I thank everybody for joining the call today. If you have any further questions, please feel free to reach out to our investor relations team. Season's greetings from the entire crew at Piramal. Have a great day. Thank you very much.
Thank you very much, sir. Thank you, members of the management. I would now like to invite Mr. Samir Bhise for the closing remarks. Over to you, Mr. Bhise.
Thank you, Michelle, and thank you to the team of Piramal Enterprises for giving us the opportunity to host this call. You may now disconnect your lines. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of JM Financial Institutional Securities, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.